Hello and welcome to this webinar on the future of equity trading, co-hosted by Financial News and the Swiss Stock Exchange. We're very privileged to have a fantastic panel here. My name is Francesco Guerrera. I am the publisher of Financial News and head of international for Barron's Group. And throughout the next 45 minutes to an hour, we'll discuss a lot of topics on this really important subject. I would like to introduce you to the panelists who will be with us today. And as I see them on my screen in this virtual world that we all live in, I can see Irina Sonic-Bright, who is Managing Director and Head of Global Execution Services Product Manager for Credit Suisse. And then next to her in my virtual, hi Irina. In my virtual screen, we have Adam Matuszewski, who is the head of equities at SIX. And then next to him in spirit, Jonathan Finney, who is head of global equity development at Citadel Securities. Between them, we should be able to really unpack what is a very important topic for all of us who write and think and work about capital markets. Now, the audience, thank you for being with us, and you will have the chance to actually ask questions in your screens. And once you ask a question, we'll be able to put them to the panelists towards the end of the session. So, without further ado, let's start. And I want to start with a topic that when we discussed this seminar, we didn't think we were going to talk about. COVID-19, of course, which has become by far the most important topic, not just in capital markets, but all over the world. The question I would like to ask is operational, and I would like to start with Adam, if possible. How did SIX deal with the crisis that was brought about by COVID-19 on an operational level?
Good morning, everyone. So I think, generally speaking, the exchanges and also the industry dealt with the crisis really well. At Swiss Exchange, we actually are working from home. 90% of the people have been working from home since mid-March. And the only people left in the office are responsible for continuous operations of our markets, and they actually had to stay in the office for regulatory reasons. We also seen that the increased volatility during the crisis has tested exchanges systems. So we've seen that the number of messages that we have seen, the number of orders we've seen in our trading systems have gone up. So we've seen around, on average, 500 messages per second on those volatile days. This represents between 1% and 2% of our matching engine capacity. And also, I think the absolute peak was on the 12th of March, when actually the number of messages reached 14,000 messages per second, but that was only for a few moments. And this was 1/3 of our capacity. So actually, this shows that there was still room to accommodate further demand for trading. Also, when we speak to different participants and we observe different members, we've seen also different responses to the crisis itself. And it is interesting that Swiss trading participants, contrary to continental Europe and the UK, decided to actually keep the majority of traders at work in the offices. So they split the offices between different locations, but actually they continue trading from their offices, from the trading floors. I think there are a few reasons for that. I think Switzerland has been less impacted by the crisis itself. Also, I think it's easier to social distance in Switzerland, especially when you commute to work. But also we know that there is a lower level of automation here among the Swiss members compared to the UK trading participants. So I think that was interesting observation. Linking this back maybe to the future of equity trading, and I think we will see going forward better flexibility, more flexibility from companies when it comes to splitting the work from home and then coming back to the office. I think the recent crisis dispelled the management theory that working from home cannot work. And in the near future, there's a lot of events industry conferences planned for the second half of the year. I think this will be very difficult to attend. I think mass gatherings going forward, especially in the near future, will be very difficult. So I think that's our experience, and that's the situation we've seen.
So do you think, Adam, that some of this will remain, some of this working practice will remain even after, say, the threat of COVID-19 has dissipated, hopefully soon?
I think so. I think already some companies, I think Twitter announced that they give full flexibility to their employees, whether they want to continue going forward to working from home, or whether they want to come back to the office. I think in the financial industry, we may see some kind of improved flexibility, maybe split a couple of days working from home and the rest from the offices. It's to be seen, but definitely there will be a change in that regard.
Interesting. Irina, I would like to ask you the perspective from a broker. I mean, did you see similar patterns to what Adam was describing, or something different? What was your experience?
Thanks, Francesca, and good morning, everyone. I would echo quite a lot of Adam's comments, specifically how amazingly well we handle the situation. Because, of course, it's not only we had to deal with physical reestablishment of working infrastructure where our traders were working across different sites, but also we had the amazing increase in volumes and volatility. So it's not only was difficult from point of view of just coming to the office and trying to do your job, but it also was very complex trading environment at the same time as well. So we split, as Adam mentioned, we split team into two, but we also have a number of people working from home. To be honest, industry during the past, I would say, 3-5 years, we already, and probably this is why it was probably so more or less smooth, because we already were trying to go towards more flexible working arrangement, where quite a lot of people already had the opportunity to work from home few times a month and so on, and probably this has helped. The other thing which was helpful as well, our latest regulations, and it's okay, it's interesting that I will be actually mentioning regulation in a positive context in here. Actually, MiFID II emphasized resiliency of trading infrastructure so much, and now we had it actually seen it in practice. So we already had distributed data centers and so on. So technology and anything driven on technology was it was just business as usual situation. What was maybe more challenging is that we're talking about electronic trading, but thinking about it where both sell side and buy side trying to find this convenient working environment in their home offices, kitchens, and wherever it is. There was probably more pressure on a high touch trading activity, which is not electronic, because we still have smaller market players out there who are potentially, they don't have expensive electronic systems. They still rely on on phone call, on email to send a broker their instructions. So I think this is where probably situation was slightly more challenging. Thinking about positioning our trading desk at home. Think about real estate over screens. You see the pictures of a trading floors right now. 6-8 monitors around there. Can you recreate similar setup at home? So this is what probably was most challenging there. But nevertheless, still I think I felt like broker community handled it very well. Thanks,
yes, thank you, Rita. I would like to bring in Jonathan here for the perspective of a market maker. Had you prepared for something like this? Did you implement those contingency plans, and what were the effects? What were the interesting things you saw as the crisis went live, so to speak?
Sure. So firstly, a big thank you to Financial News and Swiss Exchange for inviting me to participate on this panel. There are so many interesting topics which I'm excited to discuss with these excellent panelists. So from an operational impact, whilst these were clearly extraordinary times, we were very proud of the fact that we did not experience any business interruptions whilst migrating to a working from home setup. We are incredibly electronic, so our electronic model enabled us to transition effectively to a decentralized and distributed work environment. And we have been able to operate just as successfully as we would have done otherwise. We did, of course, see a tremendous increase in volume that outpaced the broader market in many areas of our business. But we were able to handle the additional volume where more manual market makers were reluctant or slow to quote because of the volatility. In US equities, for example, to give some figures, where we handle more than 20% of all equity volumes traded, our trading volumes averaged 3.3 billion shares a day in March, compared to 2 billion shares handled on our busiest day in 2019. We also helped our clients, and this is coming back to Adam's point in terms of the exchange resiliency, but to use a US example, we helped them adapt to crisis-related market structure changes, such as the closure of the NYSE and SIBO trading floors. We served as the designated market maker, for example, for 12 out of the 14 IPOs that have come to market on NYSE since the shutdown of the floor, and have helped companies raise more than $4 billion in capital since that closure. What this all highlights, and what has been very clear, is that the markets and market structure have been remarkably resilient, as Irina has already stated, throughout this crisis, because they were much more electronic, and because electronic participants like Citadel Securities were able to step up and provide liquidity much more effectively and reliably than manual market makers. 10 years ago, this would not have been possible.
Fascinating. It's very interesting what you guys are talking about, because you've all said, I think, that some of this will linger on in the future market structure. So I would like to tackle that next. Adam, we've seen some impacts on volume for sure, but also impacts on spreads, liquidity, short selling. What are the lasting impacts here of this crisis on market structure going forward?
So I think I would like to bring 3 points here. First one, we've seen that with the increased volatility, liquidity was shifting between different market models. So we definitely have seen the flight to the lit with increased volatility, especially to the primary exchanges. With increased volatility, there is also high immediacy to trade, and therefore, for example, continuous dark trading and conditional venues market share went down as a result. And also the SI, systematic internalizer market share, also declined, as with high volatility, the appetite actually to quote risk prices is lower. So that's the first observation we made. Second one, which was quite interesting and actually concerns the spreads itself. We've seen, obviously, as there is a shock, volatility shock to the liquidity, the spreads go wider. However, on Swiss exchange, the spreads went up by 200 basis points roughly in the most volatile days. Whereas in other major European markets, the spreads went up between 300 and 800 basis points. And I've been already asked by a few participants, why is that? What is the reason behind it? I think one major reason here behind this is matching technology. And in times of high volatility, the stability of the matching engine is key, because it also provides assurance and predictability to liquidity providers. And especially when market is moving very, very fast, this is key to have a deterministic technology. And we're proud that we run on a NASDAQ Extreme INET matching platform, and that has been working quite well. And we're happy with the performance. I think that was one key factor. The other key factor behind the spreads is, I think, the fact that currently, since there is no MTF competition for Swiss equities, there is consolidation of the liquidity, and potentially that consolidated liquidity was much more resilient to that liquidity shock. And also, we have not relaxed our obligations to our liquidity provider scheme. I know that some exchanges decided in those very high volatile times to completely waive the obligations. So we have not done that. That could have played a role. And the last point I want to mention here on the spreads is that we decided not to ban short selling, although this is not Swiss market specific, because there were also other markets that
Well, yeah, I think we got what Adam will rejoin us in a second. But yeah, it's interesting that the Swiss didn't ban short selling. It's a perfect segue, though, Jonathan, to come to you to see what your experience of market structure was, and you think will be, particularly in regards to short selling, stability of electronic liquidity, and so on. I mean, give us your perspective on looking the crystal ball.
Sure. So I guess firstly, I would kind of like focus on the comments on the spread. So it is worth remembering that spreads have narrowed significantly because of the electronification of the markets. A marginal increase in the cost of trading through a widening of spreads is normal in periods of heightened uncertainty and volatility. So therefore, it's important to distinguish between widening of spreads and illiquidity, right? So we were able to provide liquidity throughout the volatility. So with regards to where does this market structure go, we saw a demand, as we've previously stated, of trading surge amongst clients and general participants, many of whom needed to access their portfolios to meet financial needs during this period of crisis. in general, it's been very resilient. All participants have kind of banded together to get through this crisis. The resiliency, though, we saw in March, and it's worth re-emphasizing this, would not have been possible just 10 years ago. It is because of the electronification of the markets, not in spite of it, that we have been able to be resilient. And to echo Adam's point, it's their investment in technology which has allowed the Swiss exchange and other exchanges to really deal with some very stressed market conditions. To touch upon another one of Adam's comments, on the other hand, we did see short selling bans pop up in some European countries. It was nice to see the World Federation of Exchanges release a study highlighting the disruptive effects this ban had on participants, including institutional asset managers who ultimately represent the end investor, as well as unintended consequences for related products such as options. So the three key takeaways I had from that document was that short selling bans ultimately reduce liquidity, increase price inefficiency, and hamper price discovery, three critical variables in uncertain, volatile markets. They always say that proof is in the pudding, and ultimately the COVID-19 pandemic has given us a good, if unsolicited, opportunity to stress test certain characteristics of market structure. So far, I think we collectively have done a very good job of managing it.
Do you think, Jonathan, that, I mean, it's difficult to predict, but was this as bad a stress as it could have occurred in markets? Compared to the financial crisis, or was it as bad as that, worse than that? I mean, how would you rank it?
Sure. So I would say that they're very different. You can't really compare those two. The point that we keep, like I've made a couple of times, and I would reiterate, is that we are in a completely different place from an electronic perspective now than 10 years ago, right? So I believe that the crisis, like irrespective of the fact that they are very different, one was a financial crisis, whereas this is a very global pandemic crisis, ultimately, the market is in a much better shape, right? So to echo Irina's comments earlier, the regulations have definitely helped increase the focus on investing in technology and investing in electronification of the markets. And I believe that as a result of that, this crisis is nowhere near as bad as it could have been if more people were manual. So I'll give you an example of this from our perspective as a market maker, where for example, in US Treasuries, the aggregate difference between the prices that we quoted and the second best prices quoted by other dealers widened to more than $50 million in March from approximately $1.5 million in February. So the reason that this is that we continually invest in these capabilities and are the ones that are able to maintain price integrity during these periods of volatility. Other players do the same, and it is only now, at this point in time, rather than 10 years ago, that is possible.
Very interesting. I mean, I have a question. I love your thoughts on any of this, but I have a particular question on this because I think all three of you have touched on this. So is this the time, and certainly Financial News has written about this, is this the moment where we finally see the demise or the consignment to history of the voice trader or the human trader? Because electronic trading has been so much better.
Thanks, Francesca. So as Jonathan already mentioned, operationally we manage the situation very well because like extent of electrification within the industry. But what is not so visible is what kind of liquidity we had on the market out there, because volumes do not equal liquidity. So order books over there, I don't know if they return to the previous liquidity concentration, but were very thin as well. So yes, it was a lot of activity, but what kind of liquidity we had at the top of the book was like probably in the range of 20% versus 85%, which we've seen like before the crisis. So because of this, and because I mentioned earlier that we still have smaller companies which are not fully electronic, demand of high-touch trading activity was still quite high. And in fact, it was quite interesting to see. We didn't see the very clear sort of move towards all electronic. We haven't seen it at all. We still see, in fact, for a few days when it just started, we've seen quite big demand in the high touch and voice trading, simply because people were not, some buy-sides were not comfortable just rely on electronic activity. It's not because maybe they didn't rely into the broker system or exchanges system. They didn't rely that they won't be able to monitor potentially flows themselves while they migrate into the working from home environment. So from this point of view, voice trading was still quite important during the crisis. Going forward, I think there is still a role for voice trading, but thinking about even with voice trading is becoming quite automated as well. Voice trading is more now than just like taking an order and putting it on the market. Just like voice trading, it's more finding liquidity which is not available on the market as well. So I don't think voice trading will disappear. I think it still have quite an important role to play in this overall market structure.
So Francesco, if you wouldn't mind, I have a comment on that actually, and it's actually a positive for Credit Suisse. It's more just that what this may show and what this might actually produce is that these high touch traders or these end investors who previously could have done these things themselves are going to become more and more reliant on firms like Credit Suisse, like Citadel Securities, who have invested in technology, have invested in the electronic capabilities to support them in this. So what we may see is that you'll find a migration actually to the companies who have made the efforts to invest and have been resilient through this. So the ability to source liquidity is absolutely a critical one. But what Irina hasn't discussed, but is obviously a critical factor for the banks as well, is that they have very good risk systems, right? So they can prevent the shocks that maybe a fat finger from a high touch trader, if they were to do it manually themselves, and that would obviously cause its own shock. So the ability to have electronic risk capabilities, and risk in this case being the actual like controls, is incredibly vital in this market, and we will see that this becoming more and more at the fore of what we talk about.
That's
I would agree. Thank you, Jonathan.
Really...
Thank you for picking up on this. Sorry, I just can continue to picking up on this point, because voice trading, like now compared to voice trading where it was 20 years, it's completely different thing. So think about this additional liquidity source, because tools which goes into supporting voice trading, it's just the same way as electronification of markets went through. So as Jonathan said, we have automated risk facility, automated checks, automated tools as well, what to do, and algo selection, what to do with the order. So yeah, this is what I want to add. Thanks.
Thank you, guys. There's actually a question that is relevant to this, so I'm just going to ask it. A question from the audience right now. Scott asks, for participants concerned about liquidity and market impact, have you seen an increase in blocks crossed off exchange during this period? Have you seen any I think during this period, it means during the COVID-19 crisis, was there a big spike in blocks crossed off exchange, or was it, as Adam was saying, the flight to lit, right? Go ahead, Irina. Yeah.
Shall I? Okay, yeah. Like I might have idea which Scott is asking this question, but I don't want to make a wild guess. We definitely have a number of venues out there which provide a good block trading functionality, and we definitely seen. We didn't see I don't think spike unless Scott will correct me. But we've seen we definitely didn't see subsidizing diminishing activity in block trading. So with the markets out there, we have turquoise block discovery, we have SIBO, block trading facility, and yes, we definitely see flows going there, but don't think it would be extraordinary. I hope I have answered your question, Scott.
Yeah, we'll have to ask Scott. Adam, what do you think? More or less?
Yeah, so
less,
we look at the So I think we look at the European markets, right, and not only Swiss equities. And looking at the absolute numbers, I think the amount of blocks being done went up but simply the activity has been so tremendous that looking at simply at market share, we actually seen that the number of blocks being done declined as a proportion of the whole activity on the market.
And how do you explain that? Because, oh, Jonathan, go ahead. Sorry, go ahead.
Sorry, just I mean, like it is worth noting that I mean, like increased block liquidity is effectively increased risk, right? And we have just come through a period of increased high volatility and uncertainty. So whilst and I'm not as close to this as Irina and Adam, but the point I would make, and to bring it back to the panel discussion, is that we are supportive of the innovation that these block platforms have brought, because they are very electronic, right? They are not the case of one person picks up the phone and calls another for a block. They are a platform which allows people to meet in a very electronic space. And so we see those being these progressing and growing. But to echo Adam's point, actually, we did see a increase in volume traded on the lit market, rather than there being a really material move to block trading. But I feel that is normal.
I think that's expected, right? With the market moving very fast, you want to trade rather quickly than giving yourself a lot of time to wait and find those block opportunities. You know, the immediacy to trade increases with volatility. That's how we understand the need to trade the blocks and the need to execute. You know, I think it went down, and that was our assessment.
Great. So this is a great way to move to to move away from COVID-19 and to move to the future of electronic trading as a whole, right? Leaving aside COVID-19, where do we see electronic trading going now that it's dominating capital markets, at least in equity? Jonathan, what's your prediction?
Sure. So let us be clear, the electronification of the markets has led to increased stability and a robustness of market in structure. It's reduced the cost of trading through narrow spreads. And frankly, it's allowed us the ability to all switch relatively seamlessly to contingency locations, including working from home during a global pandemic. A lot of the arguments against electronification, where it did not previously exist, have been centered around like unintended consequences and the potential for failure in stressed market conditions, i.e. stick with what you know. What the coronavirus pandemic has presented us with is an opportunity to see how stressed market conditions have played out for electronic markets and debunk some of those concerns. So I definitely see electronification continuing and progressing as it is doing, and perhaps at a faster pace.
Irina, your thoughts? I mean, do you agree? Do you agree with Jonathan?
Yeah, absolutely, absolutely. Yeah, absolutely agree with Jonathan. This is how I see the future, is like more electronification, but also I think it's not news to everybody on this call, is that like data analysis is going to take yet another new level as well. So we will see that machine learning, it's not anymore probably just what some firms can do. Probably it's going to become more widespread. The more technology grows with capable of storing this data and processing data in a reasonably quick time, there will be more trends going towards more machine learning and eventually artificial intelligence. The other thing is about 3-5 years ago, we also see changes in the technology with cloud computing. So cloud computing now, both its resiliency and innovation as well. So technology goes very, very well, like hand in hand with improvement of products and financial services as well. So the only thing I wanted to add, so perhaps taking technology aside, we need to think about regulatory impact, like our business takes as well going forward. So and we have like impact of Brexit coming up in Europe, and how market structure going to plan out within two different segregated environments. So from a technology point of view, I think an operational point of view, we are fine, but we need to be able to deal across different jurisdictions where potentially will be complete different set of trading modalities as well. So what guys implied like before, we talked about block trading, we talk about dark trading, we talk about lead trading. What was clear is that even during the crisis, perhaps we've seen this liquidity shift to the lead books, but we're still seeing that there was a role for all trading modalities out there on the market. We had systematic internalizers, we have frequent batch auction, we had large-scale dark pools still operational and fully functioning for the end investor. That's from me.
That's fascinating. I actually got a question from the audience for Jonathan in particular, but I think, Irina, you may have a thought on that. It's from Richard, who says, as we're discussing venues, a question from Jonathan: what will the future look like for SIs after the European Commission ESMA consultations?
Sure, a contentious subject, which a lot of people have commented on. As always, when I talk about SIs, I do think it is worth distinguishing between ELP participants and bank participants. I can speak to a large degree of knowledge on ELP participants, but less so on bank participants. So I'll let Irina weigh in on that. From an ELP perspective, we have been incredibly transparent, right? We have published our volumes to TAB and Rosenblatt, or just Rosenblatt now. And everyone knows exactly what happens in Citadel Securities SI. We did see, obviously, there was a shift to lit trading. That is expected. One of the things that people don't necessarily fully grasp with the SI regime is that it is a quote-based system. So in a scenario where you want certainty of execution, then it may not be the exact avenue that you want. It is simply an additional liquidity stream that you have the optionality of utilizing. We were actually the #1 ELP SI in April, so we have seen absolute volumes grow. We understand that ESMA want to revisit this, and we welcome the consultation so that we can actually show the data as to what has been collected so far, how the liquidity provision has helped the end investors, and ultimately help frame the conversation, which currently is dominated by a couple of participants, shall we say, in terms of groups.
Great. Irina, do you have anything to add to this, or?
Yes, I definitely would like to add. It was quite interesting. Like, let me add with something else. Let me start with taking us back to the years of MiFID I. So MiFID I was introduced to promote competition in financial markets, and what we have seen rise in those alternative trading venues like MTFs, with interesting trading modalities like dark pools, reference price waiver books, negotiated trade waiver books, and so on. As soon as it happened, we have seen actually and been monitoring how quickly different markets adjust to the new environments. And it's actually we've seen that markets that embrace this competition, they definitely come out better and stronger with a better. As Jonathan said, electronification and fragmentation also drove spreads more narrow, and trading costs were quite reduced for the markets, with a healthy competition. Markets which didn't embrace competition slightly stagnated and finally caught up, understanding that they're missing out on something by allowing this alternative platforms to trade their stocks as well. So we definitely see the big role for new innovations. To be honest with you, systematic internalizer, it's not new. Systematic internalizer, it's MiFID I concept as well. It's just the way it's potentially need to be with the registration has become more widespread after MiFID II. But there is also this innovation as frequent batch auctions as well. And we see very amazing performance coming from both systematic internalizers and frequent batch auctions. We definitely can see that there is no evidence that dark pools damage price discovery, as perhaps some consultation papers might apply. What we see is definitely a significant improvement over trade performance. So, and to sort of address the worries of certain market participants where it's going to take us. Volumes on these alternative pools like systematic internalizer and frequent batch auctions still in their sort of like single-digit percentage, and I am like saying it's a single-digit percentage because there is still a lot of noise out there, like where certain technical trades being presented as systematic internalizer. So it's definitely like a very important play these new platforms have in our current market structure.
That's
Brilliant,
worth,
thank you.
that's worth re-emphasizing. Oh, sorry, after you, Adam.
Adam, go, and then we'll go, Jonathan.
Okay, I just wanted to very quickly mention what is our feedback from the industry. So we actually seen that since non-equivalence in Swiss equities since July last year, we've been actually receiving a lot of positive feedback from, especially from buy side, from asset managers on the market structure in Swiss equities, and for me that's a signal, right? It's not a signal that people don't like competition. I think competition is important. And actually, we support competition. We want competition to come back because it also fosters innovation. But it is a signal for me. But potentially, currently, the market structure is too complex, right? That's the response, and the positive feedback coming from those buy side clients is actually telling us that we should maybe think about how to simplify the current market structure, and maybe that's also a message the industry need to think about.
Thank you, Adam. Jonathan.
So there's actually, that's an even bigger topic. So I'm going to wrap. I've got one more comment on the SI bit, which I wanted to kind of like re-emphasize from Irina's excellent commentary on it. But then to kind of like go into more depth with what is actually a relatively contentious topic in itself regarding consolidation and fragmentation of the market structure, right? So from an SI perspective, to echo Irina's point, I believe that part of the fear of SIs has grown because of the overinflation of SI volumes currently. There is a lot of technical noise in the reporting of SI trades, especially from banks who utilize it for reporting mechanisms across a wide variety of aspects. So it's really, there is a current ongoing consultation, which I would encourage everyone dialing in to have a look at and respond on if they can, which is to do with the OTC data quality. This is an opportunity to really like standardize exactly how OTC data should be reported, what flags should be flagged, like, you know, should the TNCP, trade not contributing to price flag, be utilized more? How can we as an industry grow to get a better understanding of where volume is actually executing and what is actually addressable? I think that's the bigger problem. But that everyone is distracted by the fact that this SI number looks a lot bigger than it actually is, and therefore is seen as deemed as a threat to other volume venues, for example. So that's the one thing on the SIs and OTC data in general. To quickly go on to Adam's point, who in terms of consolidation and competition, right? So this is an interesting trade-off between two equally important variables for financial market structure. On the one hand, there is an argument that there is too much fragmentation and that too much fragmentation can be negative, right? So ultimately increasing complexity and overall cost of the end investor. On the other hand, you need to be mindful to encourage and support a competitive environment. In monopolistic industries, you see clear trends towards a lack of investment in technology, higher costs to the end consumer, and ultimately a less progressive framework. A balance needs to be struck between these competing tenets, increasing competition and thus fragmentation to practical levels.
Fascinating. In fact, we had a question from Tobias on this topic, so he'll tell me in the chat if he got answer, he wants to ask a follow-up. I encourage everybody to ask questions. I see them coming in. We'll reserve some time at the end, or even if we are in the middle of this. I would like to talk for a second about Brexit. Now, in normal times, we would have devoted the entire seminar to that. Quick kind of lightning round. Are you guys operational ready for Brexit? Are your companies operational ready for Brexit, Irina?
Yeah, well, we were operationally ready for Brexit already, 3 goes? I mean, we have every time Brexit was delayed, we were operationally ready for Brexit. So we had quite a lot of preparation for this. So yes, we have European entity, and we made sure that our access to European stock exchanges been done out of European entity, and this European entity will be care after European clients as well. So, but the main interesting situation of Brexit is less so much operational, but more of a point of view where regulation gonna go, because it's interesting that all this Brexit happened just after when we undergo such a big, tremendous work of implementing MiFID II across, in both UK and Europe. And it's already become clear that there are different driving forces behind certain regulations. I believe FCA were quite a strong, our national competent authority, UK National Competent Authority, were quite a strong driving force behind certain MiFID II priorities. But now they are not at the table. We potentially will see this priority shifting elsewhere. So the main interesting impact of Brexit, it will be not so much of how we can operationally handle access to certain markets or handle specific geographical located clients, but it's us handling potentially 2 different sets of regulations, let's say in 5-10 years time. So this will be the most challenging thing to look for.
So Adam, you have first-hand experience of lack of equivalence, shall we say. What can we learn from the Swiss experience if there is no equivalence?
Yeah, so many people actually are asking what is coming next, right? Is when are MTFs going to be operating in Swiss equities? And I think there is a dependency between Swiss competition and also Brexit, because we expect that depending on whether the Brexit negotiation period gets extended or not, we expect that following that, we are looking to have a UK and Switzerland moving into mutual agreement between each other, and potentially that will end up with MTFs, London-based MTFs trading Swiss equities again. So earliest next year, there is a chance for the situation coming back to normal, to pre-July last year levels. So that's one potential scenario that I want to highlight. I think generally I mentioned what was the feedback from the industry and buy side. We've seen that. There are also things that I want to mention as a result of the non-equivalence, the concentration of liquidity. We actually see that the on-venue trading activity and Swiss securities went up, which was a surprise to us. We thought maybe potentially that the fragmentation will lead to higher volumes, whereas we've seen that when the liquidity came together, there is more trading activity. Currently, when it comes to venues, so we operate the largest dark pool and the largest lit book non-equivalence, and that has consolidated really well. We also observed that the order to trade ratios went down, which is quite interesting. And also maybe with regards to something that is connected to implicit cost of trading, we've seen that the number of price movements during the day, so the price flipping went down. So the number of price updates during continuous trading in the books has reduced, and potentially that has also made it easier for traders to execute their orders.
Can I just add something?
Yeah, Irina, yes, of course.
Sorry. So yeah, thank you, Adam. And it's a very good example of a progressive trade venue which embraces competition, because concentration of liquidity on Swiss didn't happen for their own making. They didn't drive it. It was driven by politics. It was driven by loss of equivalency and stuff like this. So I just want to explain to this audience a few facts. What happened once a concentration of liquidity shifted to Swiss stock exchange? So we lost about 25 to 30% of MTF liquidity in Europe when it happens. So when we were monitoring what happened to the stock prices when it happens last summer, we've seen this that spreads on the Swiss stock increased by 10%. And what more interesting, it spreads on the dual listed stocks, which are also traded in Switzerland, actually increased by 25-30%. But what was most probably negative impact of this concentration is the cost of trading, and cost of trading from point of view of transaction costs. It depends on firms' activity in Swiss stocks and Swiss markets. It's cost of trading increased between 30 and 50%. And thinking about it's not everybody potentially will be allocating this cost back fully to their clients. So also I do understand how perhaps some smaller firms trying to say okay, we need to simplify market structure, but broker platforms there to make this market structure accessible for them. And to be honest with you, even some progressive exchanges like Six Swiss themselves order specific order types, to navigate the myriad of different order types for clients who potentially don't have enough funds to build expensive technology. The other thing, what Adam mentioned. Yep.
I think, Irina, we need to compare our numbers on the spreads because we are seeing actually different results. What you mentioned is, and I'm sorry to interrupt
I'm going to last summer numbers. It's okay.
Okay, but I think last summer when the transition happened between fragmented and consolidated market structure, I think there was also a lot of risk and about trading obligations. Can European firms access the Swiss market? And I think that initially could have impacted the spreads, but...
Okay.
And Jonathan, from your perspective, does it matter? I mean, you're ready either way, presumably, but would it be better to have equivalence or?
Just to quickly cover the Brexit thing, there's not much to add. We were ready before, we're ready now. We will be ready when it actually happens. So nothing has actually changed. From an equivalence perspective, clearly as supporters of open and non-discriminatory markets, we would favour equivalence, but we are equally ready for the scenario where this is not granted. So we can operate in any environment. We're very flexible, so we will be ready for either scenario.
Okay. Adam, did you want to continue your point since you're back on what you saw spreads do after the initial shock, so to speak?
Sorry, I'm experiencing some technical difficulties. Maybe that's a sign that I need a new laptop for the rest of the summer. I think that was a key moment, right, that I was disconnected. What I want to mention is also from the industry, from the trading participants, I also seen some studies that are showing that some of the studies showing that actually the liquidity marginally improved. I think that's not the point. I think we have not seen in the past 11 months, we have not had a lot of noise from, and especially negative noise from the trading community. And actually this shows that the period worked well. The message from us is that we welcome competition, and whatever we do is to prepare for the competition. The fees have not changed. Our projects to capture going forward and capture more liquidity and to stay competitive are still on track, and we plan to deliver. So I think we will look at that period to analyze the impact, but I think my expectation is that when we look back, we will say, okay, it was rather neutral to positive.
Okay, so I think if your bosses are watching, they should give you a new laptop, right? I mean, if they're watching, you remember you can watch this live or on demand. So if you're watching it live, do it now. You watch it on demand, do it when you watch it. When you watch this, and give them a new laptop. I think that's a good way of using this webinar.
It's actually my private laptop.
Okay, well then you have to use your own disposable income.
There you go.
So moving to the last part of the seminar, before we go to questions, I would like to focus on some of the most feared words in the industry, which is MiFID II refit, or MiFID III, as we call it sometimes in the press. So, Irina, what are we expecting? What should the industry fear? What should the industry hope for? How do you guys see it?
So MiFID II refit was quite an interesting event. It's come out in the form of two consultation papers, one from European Commission and one from ESMA. But both consultation papers sort of provided some sort of view into what regulators are looking into. And Adam already mentioned about simplification of a market structure. But you can simplify market structure different way, but it seems to be trend was going away from innovative new order types, new like venues, like systematic internalizers. A lot of questions about like meaningful liquidity coming from systematic internalizers. A lot of focus on frequent batch auctions, and even there was a suggestion was made, maybe the way to simplify double volume caps, which is restriction of dark trading liquidity, is just by getting rid of completely from dark trading liquidity. Of course, it's very simple this way. What we're seeing is we are a bit concerned because it feels like all this going towards restriction of competition, and all this is pointed towards forcing concentration of liquidity back to national exchanges. And why I'm saying national exchanges, because we didn't see yet probably big spread of alternative trading venues in Europe, because they mostly were covered out of UK. Now all UK trade MTFs also have entities in Europe. Potentially they will provide this competition, but it's a bit disappointing that it feels that both MiFID II and MiFID II refit is actually pointing in this direction. Of course, now we don't know when it's going to happen, because I think regulators now focusing on something called MiFID quick fix. It's basically recognizing that certain MiFID requirements might be adding extra burden on investment firms, and how this certain burden can be eliminated to make sure that firms can successfully cope with COVID.
Jonathan, how do you see the MiFID II refit, or even the quick fix there Reno's talking about?
Sure. So I think it's fair to say that MiFID II was relatively complex, and it took a lot of time and resources for market participants to be operationally ready. Any proposed amendments should bear in mind the current strain the industry is under as we adapt to the current global pandemic. So whilst I do say it is fair that rules and guidance are reconsidered and reevaluated to ensure the best outcome for the end investor, I would question, like, for example, the SI consultation as to whether single-digit percentages of market share is worthwhile overhauling when the industry is already under severe stress. So I think as long as the regulations and the consultations are data-driven and very methodical and detailed in their consultation, I think that is a progressive and a good thing to do. But at the same time, I think we should be very wary of unintended consequences, of which there were quite a few coming out of MiFID II in the first place. One thing that hasn't been mentioned but would go a long way to solving for some of these problems is, of course, the issues around OTC data quality, but also the lack of a consolidated tape. So we are supportive of a post-trade consolidated tape. We think that would be valuable to everybody, and it will fulfill the key MiFID II goal of increased transparency.
Just a follow-up. Oh, go ahead, of course, yeah.
So just wanted to add, because I didn't mention that one of the things was highlighted in European Commission consultation paper is how can we progress quicker with consolidated tape in Europe. Just a bit of a concern here, because it seems to be two different use cases emerging for consolidated tape. When you talk to somebody in the industry, for example, buy side, they see it as a utility tool where they could see all overall liquidity in Europe. When you talk to regulators, they see it potentially a tool to guide rules around certain a subset of data. So we need to be very careful. We still don't know where it's going to be, but if it's going to be when it's going to be delivered, we need to be cautious of this two different use cases that industry has for consolidated tape.
Adam, the exchange perspective. So, what do you guys have to fear or hope for from a revamped MiFID?
So let me first go back very quickly to the consolidated tape, address that, and then I'm going to talk about the ESMA consultation and how we see that and what it means for the future. So I think the consolidated tape, so we need to be mindful that there was also in the past initiative for the consolidated tape in Europe that has failed. I think the other point that we need to consider is that we have different liquidity sources and different venues with different levels of transparency. So the question is how, at the current point in time, how useful that consolidated tape can be. Can it be useful for the pre-trade information? I've heard some feedbacks from industry that probably not. So I think that there's still further some debate on the usefulness of a consolidated tape and its purpose.
Well, we can split the two though, right, Adam? Because you were talking about pre-trade, but would you have the same view on a post-trade? Well,
so I think the question is to you guys, right? So I rely on the industry experts that will be the users of that information.
We believe it would be useful.
And I've heard from many people that potentially the quality of the data is not there yet. So I rely on that feedback that maybe there are some venues that still having merging that all data in one central place could be problematic in terms of then utilizing that for the post-trade evaluation. But
I will just pick up on the quality. Sorry. Go,
yeah,
Adam,
I just wanted to go very quickly to the ESMA consultation, and I think that is a very broad topic and has a potential to reshape the future of equity trading. We know that regulation can be a driver for innovation, and we may see some new market models, new venues coming up on the back of that. I think general direction of the ESMA consultation is positive because, as I mentioned, I think that there is a need for simplification of market structure. However, the perspective of the exchange is that we want to understand the demands and the needs of our clients, right? And also understand the way the regulation is developing and cope and develop towards those needs. So that's our position. We feel that the future will actually see even further growth in demand for block trading. So that's one area that we touched on before, and I think block trading, on-venue block trading demand will grow even further. That's why we already plan to develop to cater that needs and have a conditional order type solution in place. The last point I want to mention that we have not touched on, but it's also maybe slightly underrepresented in the ESMA consultation, is the growth of the closing auction. And we've seen that the closing auction is a major liquidity event, can account for up to 30% of daily volume. And we've done some studies, and also I've seen some academic research done on this topic. And with the growth of liquidity in the closing auction, there is also a demand to fragment that liquidity. And we've seen some banks offering guaranteeing close solution services to clients. And I would like the industry to think about this trend, because initial data suggests that potentially a fragmented closing auction liquidity that is consolidated today results in price dislocation. So actually, initial results suggest that removing 5% of that closing auction liquidity from a single matching place results in approximately 10 basis points price dislocation. And I think that's huge, and I think the industry needs to evaluate whether that's a desired outcome. Also, some people may have noticed that there are also some alternatives that allow pre-matching of market orders. And these solutions do not affect or dislocate the closing auction price. However, what they do is actually they impact price discovery. So some academic research suggests that in the call phase during the auction, when the orders arrive, the clients are actually, the participants are reacting real time to the imbalance, to the indicative volume, indicative price, and those orders arriving in the book. And simply taking away that liquidity from that closing auction can be harmful to price discovery. So my message here is, so the bottom line here is that, we know that auctions are an important element of trading today, and they have grown in the past, and maybe we should also think about the impacts of fragmenting that closing auction space, because I think the impacts could be very different to the continuous trading.
There was a question actually from the audience, from Anna, which you answered, Adam. Jonathan and Arina, any thoughts on closing auctions and their fragmentation?
So thank you. Just a quick one from me, just to mention that the fact that industry is trying to come up with some sort of alternatives for closing auction, it shows that we are concerned that there is a huge concentration of liquidity on the venues who have complete monopoly over closing auctions. So I think we as an industry, the whole, all need to work probably collaboratively and see how we can remove impact of this monopoly. That's it from me.
Yeah.
So my 2 cents on this is this will always be a contentious topic where one set of participants, most particularly the exchanges, obviously lobby very much for a single point of entry and exit for trading volume, and other participants obviously are supportive and lobby for competition. I do believe that there is a useful middle ground that we should be able to get to as an industry that kind of does broach both those topics. The closing auction in particular will be a useful case study in terms of where Swiss Exchange could go, given that they're the only venue to execute, or one of very, very few venues to execute Swiss securities. So it'll be interesting, because one of the questions that I haven't really had a good answer from is why auction trading is more than regular trading. For example, is that because there is no competing product? It'll be an interesting question to ask to the exchanges, where the cost of trading is more in the auction than the continuous. And I'm not picking on Swiss Exchange here at all. It's more your peers. One thing that I do want to emphasize to the audience and to the members here is that we talk about competition, we talk about fragmentation, we talk about complexity of markets, but you look at the US, which some could say is one of the most complicated markets, but it functions fantastically well, and it's probably the most robust market of any in the globe. And actually it has ultimately served the purpose of the end investor. So one factor is that we have a single dealer platform in the US, and we do interact with retail in the US. We provided more than $400 million in price improvement for retail equity and options trades in March alone. So it is clearly something that I do want the European counterparts to take in mind, is that when we do look at competition, when we do talk about consolidation, what is the end result to the end investor? That's what really matters.
So that seems like a great point on which to end. Unfortunately, this is all we had time for. The audience asked a lot of questions. The panelists were fantastic. I think we agree that we had a great discussion. I just want to thank the panelists, Irina, Jonathan, Adam. I want to remind you that this is available, was available live, but is also available on demand and will be for some time on the Financial News platform. So please tell your colleagues, tell your friends. It's a very important topic that these panelists here really discussed in great detail. It's also the second in a series of 4 webinars that we are co-hosting, Financial News co-hosting with SIX and the Swiss Stock Exchange to explore the future of markets as we go into this different era. And finally, I want to thank you, because these are difficult times for all of us, all forced to work from home. It's nice to feel connected in a certain way. I want to thank the panelists to make us feel connected. I want to thank the audience who took time out of their busy days to join us. And I hope to see you very, very soon. But thanks so much for joining us. Thanks the panelists. Thanks SIX and the Swiss Stock Exchange. Thank you.
Thank you.
Thanks all.
Thanks everyone.